How to profit from a recession once in a lifetime. The 2009 Great Recession affected many people. Now that the economy appears to be headed for another dip, it's a good time to review how to utilize the recession to your advantage rather than letting it use you. Investors who lost their accounts to panic selling learned numerous lessons. If they had kept investing, they would have recovered and grown. An economic downturn's first lesson: a strong market recovery follows every recession. The second lesson is that huge selling doesn't have to hurt investors' portfolios. Recessions can be used to construct a portfolio for a quick and strong recovery. How can one make money while the economy is in a downward spiral? Curious to know more? Now let's get deeper into this. Hello everyone and welcome to our channel. Don't forget to subscribe to this channel and press the bell icon so you never miss an update. Let's start the video. Make use of the dollar cost average when share prices fall. As with most recessions, the next one is unlikely to occur. However, a stock market sell-off will almost certainly occur far in advance of a recession. When this happens, keep the first lesson in mind. After a recession, there is recovery. Knowing this, investors can use the dollar cost averaging strategy to profit from a sinking market. You are already adopting the strategy if you make monthly contributions to a qualified retirement plan. However, when the market begins to fall, it is time to capitalize by raising your contributions or beginning dollar cost averaging in a non-qualified investment account. When you dollar cost average your investments, you steadily reduce your total cost basis in the share price. So when the price rises, your cost basis remains lower than the price. For example, if you invest $500 every month in a mutual fund that sells for $25 per share, your contribution will buy 20 shares. If the stock price falls to $20, your contribution will purchase 25 shares. Your account now includes 45 shares with a cost basis of $22 on average. As the share price falls, your $500 investment buys a greater number of shares, and your cost basis decreases. When share prices rise, your monthly payment buys fewer shares, but the current share price is always greater than your cost basis. Over time, the dollar cost averaging strategy works best for investors who do not want to worry about how their investments are performing. Invest in dividends. If you're going to invest in equities during a downturn, opt for established, large-cap companies with robust balance sheets and cash flows. These companies are better able to weather economic downturns and pay dividends. Dividends serve several functions for investors. For starters, if a firm has a lengthy history of paying and rising dividends, you may be confident that it is financially sound and can withstand most economic conditions. Second, dividends serve as a return buffer. Even if stock prices fall, you will still receive a return on your investment. Dividend equities outperform non-dividend stock during market downturns for these reasons. Mutual funds or exchange-traded funds, ETFs, that invest solely in dividend-paying firms are the best method to hold dividend equities. Funds that invest in firms that have a long history of paying dividends and a great track record of increasing those payouts tend to provide high current yields while also capitalizing on capital appreciation. However, these funds are unlikely to beat the market during market recoveries. They are retained in portfolios to offer consistent returns across market cycles. As the market recovers, you can progressively withdraw from your dividend accounts. But you should always save a part as a safety net. Invest in consumer goods. Even in tough economic times, people still need to buy things like food, medicine, personal care items, and medical equipment. These are household necessities that are the last to be trimmed from the family budget. So, although companies selling flat-screen TVs and other discretionary items see revenue declines, companies selling foods and other needs do not. As a result, consumer staples businesses are sometimes referred to as defensive stocks, as they tend to be strong even when the company falters. Data reveals that these companies outperformed the S&P 500 over the last 5 recessions. Johnson & Johnson, Procter & Gamble, Conagra, and Walmart are examples of consumer staple firms. These companies often pay high dividends, which adds to their defensive profile. There are also mutual funds that just invest in consumer staples. The Fidelity Select Consumer Staples portfolio invests at least 80% of its assets in companies that produce, sell, or distribute consumer staples. This is it, everyone. So what do you think? Leave a comment and let us know. Thank you for watching the video. Don't forget to like the video and subscribe to the channel if you haven't already done that. Also, put on the notifications because the next video is going to be a great one.